Hello and welcome to our quarterly podcast, where we discuss the activities to support consistent application of IFRS accounting standards. My name is Bruce Mackenzie, a member of the IASB and chair of the IFRS Interpretations Committee. Joining me today is Mark Mahar, a member of the committee.
Hello, everyone.
Welcome, Mark. Now, in this episode, we will cover the discussions that took place at the September committee meeting. Now, at this meeting, the committee discussed two tentative agenda decisions. The first of these was classification of a foreign exchange difference from an intergroup monetary liability or asset, which effectively relates to IFRS 18, presentation and disclosure of financial statements. And the second one was on economic benefits from use of a battery under an off-take arrangement, which relates to IFRS 16 on leases. Now, in addition to those topics, the committee also provided input on some aspects of the ISB's projects on business combinations, disclosure, goodwill and impairment, and the statement of cash flows and related matters. Now, we won't cover these in this episode, but you can find more information and a full meeting recording on our website. In this episode, we're going to focus on the two tentative agenda decisions. So, Mark, let's start with foreign exchange on intergroup balances. Can you tell our listeners what exactly that discussion was about?
Sure, Bruce. So, as many of our listeners probably know, IFRS 18 will become effective on January 1, 2027. So, this is the first question the committee has received about IFRS 18, and it was a very interesting discussion. So, in this one, the submitter asked how an entity classifies in its consolidated statements of profit and loss a foreign exchange difference that arises from an intercompany loan. So, under IFRS 18, an entity is required to classify an exchange difference in the statement of profit and loss in the same category, so operating, investing, financing, as other income and expenses arising from the item that gives rise to the FX difference. So, in this case, the item is the intercompany loan. In the fact pattern, the intercompany loan, and any income and expenses related to the loan are eliminated in consolidation. Now, IAS 21, which is the standard on accounting for foreign exchange transactions, tells us that any FX difference arising on the loan remains in the consolidated accounts. So the question is, how does an entity classify the FX difference in accordance with IFRS 18 when the other income and expenses from the loan have been eliminated in consolidation?
Thanks, Mark. Now, this discussion raises a topic that might be of interest to our listeners. Now, as you mentioned, the committee did perform a technical analysis of the question on IFRS 18. But now the committee only does that if it has evidence that there's diversity in the accounting for the matter covered in the submission. Yet, as you point out, IFRS 18 is not yet effective. So it might be helpful for our listeners if we explain the evidence of diversity the committee considered.
Sure, and that's an important point, Bruce, and it's one we get often when the committee discusses questions about standards that are not yet effective. So assessing diversity is about assessing whether stakeholders have a common understanding of the requirements and can apply those requirements consistently to similar facts and circumstances. When a standard has been in effect for a few years, we can always look at practice in the market to help us make that determination. When a standard has not come into effect yet, though, we can still make that determination. For example, in this case, the submission included some evidence about the pervasiveness of such foreign exchange differences and of stakeholders' reading of the requirements. The ISB staff also had informal conversations with stakeholders who raised the same question as the submitter and informed them of differences in their understanding of the applicable requirements.
Thanks, Mark. Now let's turn to the committee's conclusions. What do we conclude on this matter?
Sure. So keep in mind the submission outlined 5 views, and the committee was very helpfully able to rule out 3 of the views and then concluded that standard setting was not needed to address the question. That said, one of the remaining 2 views was that the entity classifies the foreign exchange differences in the operating category because it is the default category in IFRS 18. Because there are no other income or expenses in the consolidated accounts on which to base the classification. Now, the other view was the entity classifies the foreign exchange differences in the category in which it would have classified the income or expenses arising from the loan before those income or expenses were eliminated in consolidation. So interestingly, 7 or half of the committee members said that only the first view is reasonable, that is the operating category only, while the other 7 members said both of the two views are acceptable ways to read the requirements. So the committee's conclusion on this has been published as a tentative agenda decision and is open for public comment until 25 November of this year.
Thanks very much, Mark. So I hope we'll get some comments from people on that. Now let's move on to the second topic, which is on the use of a battery under an offtake arrangement. Could you share with the listeners what the committee considered on this IFRS 16 matter?
Sure. So in the fact pattern described in the request, a battery owner and an electricity retailer enter into a battery offtake agreement. Under the terms of that agreement, the battery owner retains custody of the battery, but is contractually obligated to operate it in accordance with the electricity retailer's instructions, which covers 100% of the capacity of the battery, and in this case, the battery could not be substituted. Therefore, the question asked how an entity applies the requirements in paragraph B9A of IFRS 16, and specifically, whether the electricity retailer under the offtake arrangement has the right to obtain substantially all the economic benefits from the use of the battery.
Thanks, Mark. So now that you've outlined the question, do you want to tell us what the committee concluded on this one?
Sure, happy to. So the committee observed that in this fact pattern, this one described in the request, the economic benefits from the use of the battery are its storage capability and capacity. The battery is used to store and then release electricity. So the committee also observed that according to the battery offtake arrangement, the electricity retailer has the exclusive right to use the entire capacity of the battery throughout the period of use and to direct the battery owner as to whether, when, and how much to charge and discharge the battery. Therefore, applying paragraph B21 of IFRS 16, the committee concluded that the electricity retailer has the right to obtain substantially all of the economic benefits from the use of the battery. Thus, the committee concluded that the principles and requirements in IFRS accounting standards provides an adequate basis for an electricity retailer to determine whether it has the right to obtain substantially all the economic benefits from the use of the battery. Consequently, the committee decided not to add a standard-setting agenda item to its work plan and instead decided to publish a tentative agenda decision that is also open for public comment until 25 November of this year.
That's brilliant. Thanks very much, Mark. So listeners, if you want to know more about how the committee works and, of course, why companies need to consider agenda decisions when applying accounting standards, be sure to watch our explainer video. It's on our website, ifrs.org. There are also summaries of the committee's meetings that are on the website. And we hope you found this podcast informative. And with that, we'll sign off. Say thanks to Mark and thanks for listening. And we'll chat to you at our next quarterly update. Take care.
If you enjoyed this podcast, please take the time to rate, review, and subscribe on your preferred podcast player. Please contact us on communications@ifrs.org with any questions, comments, or suggestions. You can also sign up for email alerts on our website, ifrs.org, or find us on social media.